Hi, I'm James Robinson, and usually I give you my stock pick of the week, but because I think the market's so overbought, today I'm going to give you what I'm going to call my stock thought of the week, which is really a look at investment theory and what you should be looking at when you're thinking about buying companies. So my stock thoughts of the week are all going to circle around theories of value investing as discovered and created by Ben Graham in his book Security Analysis, and later taught and modified by people like Warren Buffett and Charlie Munger, Manesh Prabrai, and a whole bunch of other people. So nothing I'm going to teach you is really that revolutionary. It's nothing that I've created on my own. It's really just sort of what I've learned through a lot of reading and studying and thought on the subject of value investing. So what we're going to do is value investing theory as understood by James Robinson. Hopefully there's some value there and you can learn something. So for this first video and for the first several videos, I'm going to break down really pretty simple concepts to try and lay a foundation that we can look at in terms of investing. So the first one I'm going to talk about is the difference between investment and speculation. So to the layman and in general English usage terms, speculation and investment are interchangeable. If you asked 99 out of 100 people, what's the difference between investment and speculation, you would find that there isn't much. And in fact, if you look those words up in the dictionary, there will typically be multiple definitions, and most of the definitions provide enough overlap that it would be fair for you to say that these are interchangeable words and terms. But to the value investor, they're not. To the value investor, it's a significant difference. It's a distinction with a significant difference. And so we're going to talk about what that difference is so that you can understand that if you're going to do value investing, you're not going to be doing speculating and vice versa, and that there's just an entirely different approach to those two kinds of investing. So the definition of to invest is to commit money in order to earn a financial return. The key point here is to earn a financial return. The investment that you make is expected that it will make a financial return. It will make money. Generally speaking, that money comes in the term of cash flows. It might be that you're buying the asset for less than the value, the underlying asset, or the value of the asset. But the idea generally is that you're investing money to earn a financial return. The definition of speculation is to buy or sell in expectation of profiting from market fluctuations. So again, when you're doing investing, you're looking for a financial return, and when you're doing speculating, you're looking to benefit from market fluctuations. And those are two different things. A market fluctuation can happen independent of a financial return, and a financial return can happen independent, generally speaking, of a market fluctuation. And which of those two items that you're looking for to create value for you will determine whether you're an investor or a speculator. Now, before I go any further, there are lots of speculators who've made a lot of money, and I'm not telling you that that system is wrong. I'm not telling you that value investing or looking at investments the way a value investor does is right. I'm just going to tell you that nobody can do everything. You do need to specialize. You do need to figure out what matches your personality type. I would tell you that speculation is typically much more like gambling. You are much more likely to make money very quickly, but you're also likely to make money. You're also more likely to lose money very quickly. Whereas investing, you're taking much less risk, but you're going to get rich much less quickly. And so a lot of it's just your personality type. Do you have the personality type to do the homework and understand the math and do the numbers? Or you're a guy who likes to go with your gut and take a hunch? And the other way is, there's a significant overlap between the two. There are people who are mostly speculators but do some investment, and mostly investors and do some speculating. There aren't very many people who are sort of pure one way or the other. So we're going to go further in the explanation now. Broken down more simply, if you're an investor, if something is an investment, it should be able to create profit by itself. In other words, the market doesn't need to help you out. It should be the case that if you buy something that's an investment, it's going to generate its own value by and through its own activities. Now compare that to a speculator. There's almost no chance for you to make money off something that's a speculative investment without some help from the marketplace. So consider, for example, that you're buying a Rembrandt. Now, some people would consider a Rembrandt an investment, but it's not. It's really a speculation because a Rembrandt has no intrinsic value. It's some paint and some canvas, albeit some famous paint and canvas, but it's just paint and canvas. And the value of a Rembrandt comes from the idea that somebody else is going to pay you more money in the future for the piece you just bought today. You couldn't take it apart and sell it for its component parts, and you can't use it to generate revenue. So a Rembrandt is an example of a speculation, and it can't make money by itself. You need somebody else who wants to buy the Rembrandt to create the value. So what are some examples of investments? So rental real estate would be an investment, right? You buy the piece of real estate and then income is derived from the rents, and that's generally pretty consistent. And while there is some risk involved where the tenant might move out or rents might go down, generally speaking, all things being equal, the rental real estate is purchased based on its ability to generate income, and the value of the property is derived from the income that it produces. Another example, which is less obvious, is farmland. With farmland, income is derived from the production of crops, or maybe that you rent that crop to a farmer, but then for him, it's generated through the production of crops. Bonds can be an investment. Income is derived from interest payments. Investment in stocks, where the motivation is based on perceived value versus expected appreciation. So the idea here is that the market will fluctuate the value of a stock, but the general underlying business typically doesn't move very much. And so sometimes the market has said that this company isn't worth very much, but it just keeps trucking along doing what it has always done, and there'll be imbalances. And so you'll be able to buy the stock because you believe that the company will continue to do what it does, and over time that market will reflect that. And then the final kind of investment, which is not done as much anymore because there's just so much information out there, is that's business where the net assets are higher than the market cap, or the breakup value or the constituent parts of the business have a higher net worth and a higher value than the whole company. So back in the 80s and 90s, they used to do leverage buyouts, and somebody would buy a company and break it up into all its pieces, sell off all the pieces, and be left with a profit. In that case, the asset value of the business was worth more than you were paying for it. And another example, Ben Graham used to buy companies for a value that was less than the working capital of the company. So the stock price was so low that it didn't reflect the company's actual cash on hand. But those things are they don't exist that much anymore. There's so much information. Remember, Ben Graham's time, there was no computers and there's no ability to search. You had to ferret those companies out by looking through various publications. Now everything is digitized, and if there were companies like that existed, they probably would have been found long ago. So those are examples of what an investment is. So examples of speculation, commodities, options, currency, those are opportunities to make money, but generally the money is created by market gyrations, right? The value of the dollar versus the yen moves in your correct direction, you make money, and if it doesn't, you lose money. Same thing with commodities and currency and options. Collectibles, art, cards, comic books, rare books, baseball cards. Those are all things which can appreciate in value, and sometimes very significantly so. Sometimes it takes a very long time for that to happen. Oftentimes you can find a lost piece, in a garage sale or something, but generally speaking, the value of a collectible is that somebody will pay you more for it in the future than you paid for it today. Raw land, generally, we're talking about raw land other than farmland, that's like raw land in the middle of town. Wealth is generally created by perceived supply and demand and scarcity. So a vacant lot in the middle of town, you're really buying it, unless you're a developer, you're buying it with the idea that someone else is going to come and offer you more money for that land later. For a developer who's going to develop it, he's buying it as an investment for the rental income that it will produce. So you can see that the same piece of land might be bought for two different people for two different reasons. And in fact, the person who buys the real estate as a speculator often is expecting an investor to come along and convert that into an office building or an apartment building, whatever. Finally, investment in some stocks can be speculation. It's an investment motivated by a perceived price movement versus perceived value. I would argue that everyone who's buying Tesla today is really speculating that someone else is going to pay a lot more for the company, much more so than they're saying that the value of this tiny little car company is such that it should be worth more money than, whatever it is, Toyota, or more money than Ford and GM combined. And I've done some videos on Tesla, that I'm not high on it, but I think that there are examples of speculation in terms of stocks like Tesla. During the internet bubble in 2001, one could argue that virtually every company in the NASDAQ, or a huge portion of the number of companies in the NASDAQ, had been bid up by speculators because there wasn't really very much underlying value in the companies. So as an income investor and not a speculator, what do I look for when I'm going to invest? First, I look for an income stream that can be identified, right? So I'm looking at the profits of the company, and I'm trying to determine if that income stream is relatively consistent and something that I can use to identify real value. The next thing I want to understand is, can it be quantified and understood? Do I understand this process through which the money is made, the products they're producing? Do I understand the fundamentals of the business well enough that that income stream starts to become something I can really quantify as being real and sustainable, and hopefully grow, that it will grow over time? And all of that homework leads me to believe how predictable those income streams are. Once I know that the income stream, what it is, how it's derived, and how real it is, I can start to project into the future how much the income I think will be worth in the future, and that allows me to be comfortable that the valuation I create today will still be applicable, several years into the future. Then you're just trying to assign a value to that future income stream using some sort of discount rate. And that really is sort of, we're trying to calculate the intrinsic value of a company. And then once we know the intrinsic value of the company, we look for a margin of safety, which means we'd like to buy something below the intrinsic value in case there's something we didn't understand or we didn't catch, or some bad news arrives on the horizon, so that we don't lose all our money, and so that we hopefully can generate some profits, even if things don't go exactly the way we hope they would. And so again, the key thing to note here is that for a value investor, things tend to be driven very much by the profits of the company and how those profits are derived and how consistent they are. Speculators, on the other hand, have a completely different perspective. They're looking for imbalances in supply and demand. They're looking for momentum or hype. They look for scarcity, potentially disruptions in supply and demand. Oftentimes, people who look at charts would be speculators. They think they're seeing things in the past, gyrations of the company, that will lead them to believe what's going to happen to the company in the future. I'm not making a valuer's judgment as to whether they're right or not. I'm sure some of them are brilliant enough to do that. I'm sure some people aren't. And the same could be true for value investors. But that's an example of a speculator. But everything is driven by stock and asset prices versus being driven by the underlying business. Again, the thing to know with investing is that you're really valuing the underlying business first, and then from that deciding what a share of stock would be worth. Whereas the speculators are really saying, what's a share of stock worth, and what's it going to be worth in the future, almost without concern for the underlying business. So this is sort of my first indication of what we're going to be talking about, which is how, as a value investor, we look at companies, we understand companies, we value companies, and trying to apply that discipline to creating investments. And it also is going to give you a sense for the kinds of things we're not going to be doing, and I'm not going to be teaching you to do, which is commodities or options or collecting or charts or any of that kind of thing. Those aren't skills that I possess or claim to possess. I haven't spent any time developing that. So if those are the kinds of things you want to do, I'm sure there's lots of great resources on YouTube and other places. You should follow them. But if you're looking to be a value investor, hopefully this is a down payment on future lessons, and hopefully you gain something from this. I'd like to know if you'd like to follow me on Twitter, see my stock picks as I create them. My stock symbol, my Twitter handle is @RobinsonStocks. So thank you very much for your time, and I'll try and do more and more of these lessons going forward, as I'm not giving you stock picks of the week. Thanks for your time.